Thank you for joining us, everyone. We're delighted to have you here at Refinitiv's webinar, Good Citizens, Analysing Corporate Behaviour in the Context of COVID-19. I am delighted to be joined by an illustrious panel, and I'll take you through them in a second. Allow me to move us on. Here we go. A couple of housekeeping things before I do. You can submit questions in the questions and answers box. We'll answer these either during the course of or perhaps at the end of the initial portion of the webinar. And you can use the tools at the bottom of the webinar screen to access resources such as the speaker biographies and the webinar material, so on and so forth. So hopefully we've given you access to everything that we're going to take you through here today. With that, let me introduce the panel, or indeed, I may indeed allow the panel to introduce themselves. Chaka, why don't we start with you? Brief introduction, please. Chaka, can we hear you?
You might be able to hear me now. I was just saying, thank you very much for having us on board with this fantastic webinar. Grateful to Refinitiv for the invitation. Just by way of a bit of background, I spent the best part of a decade working in the City of London and Central London as a corporate employment lawyer for one of the big international city law firms, where I was mainly concerned with dealing with the S. I was at the coalface dealing with the S in ESG. And I've just finished a decade stint in the UK House of Commons, where I held a number of senior positions for our two principal opposition parties, the Labour Party and the Liberal Democrats, where I was responsible and led on policy very much in the ESG area. And I now work as a strategic corporate advisor to firms, advising them on business critical issues, ESG in particular.
Great, thank you, Chaka. Tessa.
Hi, I'm the Green and ESG Financing Editor at Refinitiv, and I'm responsible for covering the capital markets. I look at banks and institutional investors, and I look at all asset classes and all regions. So it's a very overwhelming position, but also extremely interesting. And so we're really following the capital flows and all the financing trends. And prior to this role, I was the global loan editor at Refinitiv, and previously to that, Thomson Reuters. So I have a long background in debt markets. And thank you very much for having me on today.
Thank you, Tessa. And Andre, please introduce yourself.
Thanks, Leon. Andre Shepler here. I'm the director of ESG at True Value Labs. For those who are not familiar with True Value, we're a technology company founded in San Francisco that provides ESG data as well as credit data to institutional investors. I've studied sustainability at Columbia University, and prior to True Value, I was at UBS Investment Bank for over 8 years, primarily in equity research and trading. So happy to be here. Thanks for the invite from Refinitiv.
That's great, Andre. And you're based in the US, so it's very early in the morning for you. So an extra thank you to you for joining us. So let me start with an opening question, which hopefully is nice and broad and allows you to sort of, set the theme from your perspective. Environmental social governance factors, or ESG, and sustainable finance more generally has become a really important topic and has become more and more central to how investors think about allocating their capital, how banks think about helping to raise new capital on the financial markets, and it's become more and more central to the way that corporates themselves think about their own transitions, their own transformations, their own strategies. What's the relevance of ESG and sustainable finance in a post-COVID-19 world, post-crisis? Chaka, your thoughts first. Chaka, you're on mute again.
Apologies. If the debate around ESG before the pandemic hit in most of the Western countries around March was reaching a crescendo, and of course it was the main topic of conversation at the World Economic Forum gathering in Davos. A big debate was kicked off by the Business Roundtable in America, the collection of CEOs over there. arguing that ESG should be taken more seriously and threaded through what companies do as opposed to being an add-on, as sometimes corporate social responsibility was. If that was the position before the pandemic, I think it's going to be even more so in the wake of COVID-19. Why do I say that? I say that because, well, two things. First of all, if you look at the public opinion data and how people feel about businesses' handling of the pandemic, it isn't good relative to other sectors. So here in the UK, for example, a third of UK workers don't actually have confidence in their leaders' approach to the way they've been dealing with the pandemic. And globally, less than a third of people think that CEOs have dealt with the pandemic in an outstanding way. And unusually, actually, government people are scoring much higher. And of course, you'd expect the scientists and the health professionals to score very well on that count. And so there is actually a big job of work to be done by business leaders to be active, but also to vocalize what it is they're doing, because there are companies out there who are doing good things. The second thing to say is that there is going to be a lot more scrutiny of what business does coming out of this, because where public sentiment is. And, you know, there are 3 or 4 big debates that will dominate the discussion, certainly politically, over the coming years. And we'll see a crescendo around this in the lead into the US presidential election in November. It's issues of equity, because clearly the pandemic does discriminate and it's having a disproportionate impact on certain groups. If you're of color, for example, you're much more likely to be killed by it. And if you live in certain places and from certain groups, you're going to see it hit your income disproportionately relative to others. That's going to be a big issue of debate. Secondly, how do we pay for all the support that governments are providing? Because austerity is very unfashionable relative to where we were in the wake of the global financial crash, but tax rises are going to be necessary. Who's going to pay for that? And there's also the issue of globalization. You know, you will see a lot of populist politicians on the left and the right arguing that this shows the excess of globalization that we've had and that we should row back. All of that is going to directly impact on the business environment for firms. And unless they can illustrate that they collectively are doing the right thing, they face heavy regulation, higher taxation, a reduction in being able to move around the globe and do their businesses. So it's not just the pressure that will come from the public, citizens and consumers, on companies to make sure they've got good bona fides on ESG issues. You know, the bottom line and your performance, your share price, the dividends you'll be able to pay, all of this is going to be impacted by sentiment and how people feel coming out of the COVID-19 crisis.
Great. Thanks, Chuka. Tessa, your thoughts?
Yeah, I think before the COVID-19 crisis, we were seeing, as Chuka said, a sort of acceleration of the discussion around particularly environmental factors, so the E part of ESG. And I think that the S part of ESG, the social side, was starting to come forward. I was definitely starting to see some of the targets being linked to social targets on some transactions towards the late last year. However, that side of the markets and financing arms was relatively underdeveloped. And I think what we've seen as the crisis has rolled through the markets is that the S side has really come to the fore. The COVID-19 crisis itself has been defined as a social issue. And I think that one of the things that it really has revealed and in stark detail is social inequality. And this is actually becoming more and more of a topic and rising up the agenda. So what we did see in the wake of the crisis was a big switch into social as multilaterals and sovereigns and supranationals started to raise money, which we'll talk about later. But I think the S part of ESG is very firmly in focus. I wouldn't say that that takes the focus off the E either, but it does show how intimately all 3 factors are connected, and the aspects that Chuka just closed on there about the scrutiny on companies' performance from investors that are knowledgeable in this area is going to be very intense. So that's the G side as well. So I think it just reinforces the circularity of the ESG analysis and highlights its importance really in terms of, I think the companies that have done the thinking on that front are probably performing better. And well, they are performing better. We're seeing quite a lot of evidence coming through on that front. So I think instead of sort of putting ESG on a back burner, it's thrusting it forward even further and even faster and forcing a lot of work to be done on the social side now.
Andre, do you agree?
I do, and I would I would echo what Chuka and Tessa are saying, especially around the S, and that's something that our firm, who were able to gather information and data on sentiment, we've essentially documented that, and we've seen that over time. And sort of the slide here shows the S of S&G rising through March and through April when it comes to public perception and sentiment and what stakeholders are discussing around companies. So I do think that's true. I think, part of the ESG narrative that has been, prohibitive in the past and remains a debate is around this performance issue, particularly on the investing side. But I think, what this humanitarian crisis has unveiled is that no matter what the business operation is, across industries and sectors, there's going to be an impact, right? There's going to be externalities and there's going to be unintended consequences on people. And so, investors are really changing the way they're doing analysis and thinking about these things in terms of, a company's earnings algorithm and how can we assess these externalities and when they'll be internalized. And I think, because there's such a human element to what's going on, the awareness from owners, whether it be asset owners or retail owners, is increasing around these issues, and that's really what's driving, the driving force around ESG investing. So I would echo that it's likely to continue.
So thanks for your thoughts. Couple of pieces of data which are worth highlighting, and perhaps I'll let you guys comment on in a second. The assets under management which identify themselves as ESG continues to increase. There is actually a question which we've had come in already, which is whether or not there is enough data to support the thesis of outperformance of ESG. And is the outperformance attributed to ESG factors or simply better investment decision allocation or allocation decisions? And I think that's a question that might be worth answering within the context of looking at some of this data. So this is the data of assets under management that continue to go to ESG. The data on green bonds tells a slightly different story in terms of green bonds are not the only form of sustainable financing, of course, but they're probably the most mature product within sustainable financing. And that's sort of decreased in the last quarter with the COVID-19 crisis. Interestingly enough, social bonds, particularly COVID-19 bonds, have increased, but the green bonds have decreased. Is that a short-term impact, Tessa? From the sounds of it, you think that it is a short-term change, and that in the long term, won't affect the drive for financing around E as well as S in the long term. But any additional thoughts that you have on that?
Yeah, I do think that this is a short-term effect. I think that the pandemic did force a very quick switch into social, and the fact that that could be accommodated and that could happen was, I think, positive as well. So we did see green bond issuance dipping. I think March was the lowest monthly total that we've seen pretty much since the early days of the market. But I think that some of the longer term, these facilities do actually take quite some time to set up, especially if you haven't done a sustainable financing before. I think what we saw with the rise in social was that existing sustainability issuers were switching into social very quickly to raise money and to disperse it through their countries and their populations. So I think what we'll see on the green side, I do think green bond issuance is going to pick up. We've had several bank issues already this week. Late last week, we saw a deal for Citigroup. We've seen one for Credit Suisse, and we've seen one for Deutsche that's being flagged. So I think that as the regulators and governments are going to need the banks to pump the cash through the economy, I think that we could see a lot more, certainly, bank green bond issues. And generally, because there's still a big question about whether or not political stimulus is hooked up to environmental incentives. And if that happens, that will certainly boost green volume substantially. But I expect it to revert to its pre-COVID levels. I think that it might take a little time for it to pick up again, but I do expect the general trend to continue in the upward direction. And I think that we also, you just said that green bonds are not the only sustainability instrument. We're really seeing three types of instrument at the moment. We're seeing green bonds, we're seeing social bonds, and then we're seeing sustainability bonds, which are a mix of both. And I think that issuance on all three fronts should continue to increase. I think that even now, even in the most difficult of circumstances when everybody's working from home, I know that there's quite a lot of work going on for companies that don't have frameworks in place to do that work and that thought and make those institutional changes, even in really difficult circumstances. So I do expect that to continue to rise. I think green bonds might be a little lower for the very short-term future, but I think it will revert.
Great, thanks, Tessa. Andre, moving over to you. And Andre, in addition to your thoughts, just as a reminder, I know you have a couple of slides of data that you prepared. If you do want me to move to them, just let me know and I can shift to them if they're useful in answering this question or downstream, just as a reminder.
Sure. Yeah, and you know, with reference to green bonds, I mean, I think that it's actually a relatively nascent product within the marketplace, as opposed to you know, funds that have established themselves as either ESG specific or integrated. The growth in sort of whether it's socially linked bonds or green bonds has been enormous, but as a percentage of total issuance, still relatively small. So during this recent crisis, I think that, you know, you've seen sort of a credit crunch in other classes as well, like structured products, for example, issuance is down 25% or so. So I do think there's sort of a natural tightening that you get with uncertainty within the marketplace that's going to sort of feed into that sort of down number in Q1 on the issuance side. And you know, I think going forward, you know, this is really an important area for banks to innovate, right? When you know, if we take a look at it historically, in the 80s, banks innovated a ton around different, you know, exotic financial products that were primarily based on you know, allowing investors different ways to bet on the market and to juice returns and so forth. If there's innovation, you know, across the sustainability-linked loan and green bond space that allows investors to take different views, particularly on how companies are performing with respect to sustainability, that will provide more liquidity to a lot of these institutional investors that are saying, look, like, we want to invest sustainably, but we don't know where to, you know, best use our you know, our assets. And so I think, you know, this downturn will prove on the issuance side temporary. And I think what we're seeing is a lot of governments are taking the same thought as to, you know, as we try to extend credit in this recovery, how can we link some of these sort of important societal outcomes to the covenants within lending. So I think it's a good development.
Yeah, I think that is definitely a trend that we're seeing in the data, Andre. So yeah, really good point there. Chaka, any additional thoughts at this stage on, you know, the data that we're seeing, those potentially contradictory trends on the financing side versus the funds and assets under management side? One sees growth, one sees downside. Any further thoughts?
Well, I just think that there are two thoughts. One is, if you look at the volume of green bond issuance in the first quarter of this year relative to last year, I think there is a drop, but it isn't a huge one. I think it's 3 or 4% on the last figures that I saw. Obviously, we need a refresh. The figures I saw were going up to the end of March, but obviously we need to take into account April as well. But if you look at falls in other areas and you just look at how the indexes of equities have fallen, you don't see a drop anywhere near as big. Secondly, if you look at the ETFs as well, they are outperforming their ESG ETFs are outperforming their parent indexes too. And I think a lot of this goes to general resilience. The governance structures and the general culture of a lot of the ultimate entities that are invested in are taking much more of a long-term view and preparing for shocks like this in a way that other companies aren't. And I think that is coming through now. That's partly anecdotal, but I think there's also different data sets that companies like Refinitiv are producing to evidence that fact. And I think from the point of view of boards, I think that they are going to have to take a step back and consider whether or not they were prepared for this crisis, not necessarily for this crisis, sorry, but for a big external shock like this. And there will be a need to change structures and systems to be able to adapt and respond.
Good. Look, I think that takes us on to my next question, which is really focused on what are the expectations on companies going forwards, given what we've experienced in the last couple of months. And I guess within that, I think we've seen maturity in the market over the course of the last few years, where ESG went from being seen as sort of an altruistic sort of set efforts that corporates might undertake or investors might undertake to actually being seen as much, much more core and indeed self-interested, recognizing that on a long enough timescale, focusing on managing your carbon footprint, focusing on managing your risks associated with having appropriate cognitive diversity in the organization, all those things were then about enlightened self-interesting and running an effective business. What are the expectations of corporates going forward, do we think? We have some data on screen here around companies and the amount of sustainability reporting that they are doing, and we can see that that's increasing, which is probably a reflection of the extra activities that they're undertaking within the organizations themselves and the additional focus on that. Do you see that continuing? Do you see that accelerating? Sorry, I should probably ask who I'm asking first. Let's go with Andre.
Yeah, I was just going to say, I think there's a couple of specific things that companies are going to heed going forward. One is cash management, right? Because a lot of companies are really balance sheet making through this crisis, and I think if you assess, cash return policies versus reinvestment rates and things like that, the expectation is that there's going to be much more an expectation of much more longer-term thinking by management. Right, you have the airline industry as an example where they're, taking excess cash and buying back stock when there's a lot of real, investment needs and also sort of cushion that's necessary given the nature of that business. So better cash management, and then, I think there's going to be an increasing sort of awareness of carbon reliance, and you spoke to that just now, Leon. But what we saw with this oil sort of demand shock is really sort of a glimpse into the future, right? Because as governments and other sort of institutions and policymakers get more serious on climate, which has to happen, it will necessarily impact oil demand, right? No matter what BP's forecast is, or the EIA, or what have you. So what we saw is an early glimpse of that, and I think as companies are moving forward, carbon disclosure really must be an element of reporting, because it's as essential as a company's debt, right? For an investor, if I don't know how much carbon your business is relying on, how can I model what your costs are going to be going out 5-10 years when there's prices on carbon? So I think those two are specific things that companies will be looking to deal with going forward. And then just to say one thing on the values versus value debate, which has been an evolution in sort of the ESG space, and something that we've written on, and I think is quite interesting, because what you have, there are a set of normative values that sort of society harbors together, and what you've seen is sort of the manifestation of these values becoming material for company financials based on what stakeholders are seeing out there, right? Like if you look at the 90s, in an example like Nike, it took 5 years for them to address their supply chain issues, right? But it came from, journalists poking and prodding and saying, hey, look, this is not right. Like if your customers knew about this, it would materially affect their decision. That was a 5-year process, 20 years ago. Now that's a day process via social media, right? And so I think companies are, have a heightened awareness of that, and that transparency is driving the need to focus on ESG, because it is sort of a shared value type of equation. So.
Yeah, very good. Chappie, you sort of started us on thinking about expectations on corporates going forward. Additional thoughts?
Well, I think there are two things, and there's what investors expect, and there's what society as a whole expects, and I put into that bracket citizens, governments, other stakeholders. I think on the side of investors, I think increasingly you are seeing ESG issues really impact on the bottom line like never before. And, just to use one example, impacting on perhaps the most powerful one, some would argue one of the most powerful companies in the world, Facebook. That Cambridge Analytica scandal, without going into all the detail of it, obviously goes to governance, it goes to social issues, people's privacy, how a company behaves. In the immediate aftermath of that controversy, Facebook saw a more than $100 billion drop in the value of its market, in its capital, market capital. So if you don't deal with these issues and you allow ESG controversies to emerge, it is going to wallop you financially, and there's no doubt about that. The second thing is just in terms of how society is going to be looking at companies going forward. There's a whole set of behaviors and things that people did in the wake of the global financial crash. I know, well, I sat on the main parliamentary committee looking at these issues in the wake of the global financial crash, and the way that, particularly in the financial services sector, people just resumed their old habits and carried on behaving as if we hadn't just had this enormous historic financial explosion was extraordinary. Companies are not going to be allowed to get away with that type of behavior in the aftermath of this crisis, albeit it is, a humanitarian crisis. It's not born of bad behavior in a particular sector. But companies will have massively benefited from the support that governments around the world are providing. And so there are certain things and issues that were not as controversial a year ago that will be much more sensitive now. And the obvious ones are when you resume paying a dividend. The Bank of England here in the UK, our central bank, put huge pressure on the banks not to pay a dividend recently. That is going to be a very sensitive issue. And of course, if you're not paying dividends, then pension funds on whom we rely to sort us out in old age is going to impact their performance and value too. So there's another side to that coin. But that is going to be a very sensitive issue. Secondly, executive remuneration, that is going to be a huge issue as well. So we've seen some of the biggest supermarket groups in the UK benefiting from the government relieving them of having to pay business property taxes here. And so they're enjoying not having to make those types of payments. But at the same time, just this week, we've seen Sainsbury's and Tesco's, two of the biggest supermarket groups here in the UK, announcing, partly because they're required to report it because they're listed, but announcing, big remuneration packages for their leadership teams, and that's plastered all over the papers. The third area, which has almost become toxic, is if anybody attempts to do share buybacks. The number of companies who are asking for bailouts and relying on taxpayer support, both in the UK and the US, who have weak balance sheets and have done big share buyback, engaged in big share buybacks, is really coming back to haunt people now. So those are just, I suppose, three areas where previously you might get a bit of noise from an activist investor at your AGM, which are now going to become very big issues impacting on your brand and reputation. The final thing I'll just say on this, at risk of conforming to the stereotype of a politician going on too long, is that consumers have made it clear. There was a survey that came out last month that Edelman conducted across 11 different countries, but a third of them are saying not just that they'll look badly on companies that don't do the right thing through the pandemic, but they are actively going to seek to persuade people not to buy the goods and products of those firms, and that they've already done so. And so these broader reputational issues vis-a-vis the public are going to adversely impact if you don't get them right.
Great. I'm not doing a very good Jeremy Paxman here of shutting you up, but I think that was really interesting, Chaka, so thank you. Tessa, final thoughts on that question?
Yeah, I think companies have got, it's really a question of the thought and the work that has to go into that, and there is a cost to that in terms of time and energy. But I think that there are so many overlapping regulatory requirements that are coming through that companies actually really have to do the work, even in the most difficult of circumstances, to get ahead of this issue for some of the reasons that Andre was talking about, for perhaps an impending carbon assessment, or even there's discussion of other incentives around carbon. But companies absolutely have to start to do the work and to generate the data if they don't already have it, because they will be asked for it. The investors who are leading in this space are very sophisticated in types of questions that they're answering. I know a fund that's been talking to their own bankers, and they want to know in detail which deals the banks are underwriting. I also feel quite strongly that the level of awareness in society is getting quite sophisticated now around consumer decisions, but also the pressure groups that are active in this area have done some really amazing work on analysing exposures and pointing out some of the decisions that are being made. I mean, ESG is a very interesting field because sometimes the decisions highlight some of the competing pressures that are on institutions at the moment. We're seeing a short-term increase in lending to high-emitting companies because it's a crisis and banks are being asked to support companies and to support jobs. However, we have competing demands on their time and capital because pumping more money into fossil fuel sector is perhaps not the way that we want to go forward. So there are a lot of difficult decisions to be made, but I feel like the level of sophistication is high. Like, social media does shine a light. The groups that are forming around this, some of the work that's being done is actually really excellent. And I feel that I really feel that companies really need to get ahead of the curve and to get ahead of regulation, because I think it is coming. We are already seeing the Bank of England stress tests. We're seeing the TCFD reporting requirements. All institutional investors are obliged to report and to map their portfolios now. So this issue really isn't going away, and neither is the climate crisis. It might have been superseded in the very short term by COVID, but you can even argue that COVID is perhaps, in a broader sense, an element of the ESG crisis as well. I've certainly heard that from investors. They're worried that the lack of biodiversity is making us more vulnerable to pandemics. So there's a lot to think about, and I really think that this data is absolutely going to be required. So the thought and the work needs to go into being able to generate it, and companies will be asked for it. And I don't feel like investors' engagement teams are going to stop with those questions. I think they're only going to increase. So they really need to have some answers if they want the capital to support their businesses going forward, institutionally, and also consumers are very sophisticated.
Great, thank you, Tessa. we've got just tons of questions coming in already. I have a couple more, and I'll try and interweave a couple of those questions. One of them is just a factual question around what we're seeing on screen at the moment. Is this global? Is it European? It comes from Refinitiv's own ESG database around what corporates report, and it's a global database. But to the degree that you want more information, of course, follow up with us offline. I'll come back to the question which we didn't really do justice to, which I mentioned earlier, and which we've touched on, but which I think deserves a little bit more attention, which is this issue of the correlation between ESG and performance and whether there's enough data to sort of support that correlation. There are a few pieces of data which are worth highlighting, which we've seen over the last couple of months at Refinitiv, including the net inflows into ESG funds versus outflows into other funds. The performance, superior performance of funds which identify themselves as ESG funds versus other types of funds. I think there could be various factors behind that, including, the ESG funds tend to be less exposed, tend to have less exposure to things like oil and airlines. And so they're, very meaningful reasons why they may perform better. And looking at, indices, companies and their ESG scores and how they perform versus others, there does seem to be strong correlation there in terms of superior performance, at least superior resilience, which is, I guess, the question that I want to ask now, which is resilience very quickly has gone to the top of the priority list in terms of thinking about attributes that companies need to have to be thought of as sustainable and to be thought of, quite frankly, just as good companies and good performing companies in the long run. Is resilience a new ESG attribute going forward? Broad question to the team. Andre, let's start with you.
Yeah, I think it actually has been, right? So if we think about from like a sector basis, what's driving the outperformance, it's really clear, right? Tech and healthcare have been outperforming, and those are definitely, skew heavier and more overweight within ESG funds, whereas, as you mentioned, energy and fossil-based types of operations are going to be underweight or not exposed at all within ESG funds. But what I think, if you think about why that is, I do think there's this correlation around, ESG gravitating towards intangible value. Right. And if you think about the makeup of market value and how that's changed over, say, 50-year time period, right? It used to be, harbored in physical assets, and now it's mostly harbored in intangible value or intellectual assets, right? So I think ESG skews heavy towards the intangible side of value within the marketplace. And that's, you're seeing that be a resilient strategy in the last 3 months. But I think there's other evidence that shows, that aside, if you look at some of these important sort of ESG behaviors, that you're going to find all else equal outperforming for this better sort of ESG behavior on critical issues. And evidence of that has already come out. So George Serafim from Harvard Business School and the team at State Street did a study on the S&P or U.S. universe during this recent crisis and looked at companies and how they perform with respect to labor relations and supply chain management, and found that firms with more positive sentiment on those issues outperformed during this recent crisis. So I think, and there's a couple other studies I won't mention, but come to mind that show, sort of all else being equal, you're still seeing this premium on sort of, part of it is quality of management, right? But I think it's still something that is unique to firm behavior, and not necessarily, if you take the sector or industry skew out of there, I think you're still seeing this resiliency from a performance standpoint. A lot of that has to do with, unearthing intangible value through ESG analysis.
Great, thanks, Andre. Tessa.
Yeah, I've been talking about this over the last few weeks with various different sort of players like banks, investors, and also some of the companies that do some of the data work. So I think the feeling originally was, as you said, that perhaps these highly rated ESG companies tend to score well have come out of the crisis very well, actually, in terms of their performance. And initially, there was quite a lot of skepticism, and a lot of people were saying it was because of their reduced exposure to the oil and gas and fossil fuel sectors. However, I think what's coming through perhaps more and more is the governance aspect, the G of ESG. Like, everything comes down to the management. Like, have the management actually done the work? Do they have a policy? Can they issue quickly? Are they well adapted and suited to just be able to respond to the environment that they find themselves in? And I think we are seeing that coming through more. The questions that are being asked are very searching, and I think that if the money that's being directed into the highly rated ESG companies is driving its own trends. Certain sectors are very attracting a large amount of money, but I think what we're seeing overall is just that, like, have you done your homework? You know, are you ready for an environment that is probably not as we have seen before? Like, it's probably going to be a more volatile environment going ahead. You know, now we have a COVID crisis. At the same time, we still have a climate crisis. So we could see, like, extreme weather events compounding the effects of the COVID crisis now. You know, things are on the climate targets that we've set for ourselves, we're still lagging, and until we actually start adhering to those climate targets, things are probably going to stay quite volatile, and there will be a number of crises that have to be dealt with. So I think that the companies that are forward thinking in this respect are starting to pull ahead, understandably.
Very good. Chaka, thoughts on resilience?
I think this is, as we were talking about this, I was kind of going back to my days working as an employment lawyer in the city, and the fact that, you know, how do you quantify the value and really assess the value of whether a company is doing the right thing on ESG, and particularly on the G part, actually, or the wrong thing. And it seems to me there are two issues. One is, you know, when you look at the different ratings there are out there, of course, a lot of this is driven by disclosure and the information that the company gives to you, which of course is going to be rather rose-tinted. And, you know, ensuring that you have a kind of outside in, you know, kind of look at what they're doing, which is kind of independently assessed and factored into the ratings that they're given, is really important. But the other thing is just exactly how do you quantify whether, you know, what the downside is, and how do you actually give that a value? Because it's often a contingent liability that hasn't crystallized yet. And of course, on balance sheets, you make provision maybe for ongoing litigation. But what about if it hasn't got to that point where you can either assess what the liability would be, but you know there is going to be a liability there? And that seems to me a big unresolved issue for every company. I also think there's a cultural dimension to this too, because as a lawyer, as a solicitor, people always resent having to pay your fees because they're not necessarily seeing a kind of output in terms of a product, whether it's a service or good, that has come from the result of what you've been doing. The main thing that they've seen is not having to deal with certain issues, and they resent paying your fees because they can't measure what you're charging against what they otherwise would have had to pay out in terms of the downside legal liabilities. And so this whole way of thinking about these issues requires a bit of a cultural shift. And that's going to take time, I think, for the corporate community to adjust to, as these issues become much more prominent on risk registers, and not just risk from a potential, you know, from the point of view of corporate manslaughter or directors being hauled into a court because health and safety obligations haven't been complied with, but financial risk.
So, thinking forward post COVID-19, I guess if we look back at the last few years, there's been an enormous focus. Think of green bonds we were talking about earlier on the E of ESG. We've talked about climate a few times, just sort of anecdotally, even in this conversation, without it being a central discussion point. But I guess with COVID-19 and the crisis, the humanitarian crisis, as well as the economic crisis, do we expect the thematic focus on ESG to shift or change, and the balance to shift or change? Tessa, you sort of spoke about this very briefly earlier on. I definitely want to pick up on it. There are kind of few key themes in ESG which tend to rise above the others, for better or worse. Sorry, Tessa, just to finish the thought, climate is sort of central to that. Social issues and social funds, social funding, social financing going to become more and more prevalent. Sorry, Tessa, I didn't mean to interrupt. Carry on.
That's all right. No, that's fine. I guess I think what we're seeing in social finance is really interesting. I'd say the social side of sustainable investing is a little bit underdeveloped compared to its green counterpart. Now we have very tight standards of definition and issuance from Eikon, and we have the EU taxonomy, and we have the looming EU green bond standard as well. So we have tight definitions for green. The definitions for social are less well defined. They throw up some very interesting issues about, for investors, about, what types of groups of people that they can support. I think we have seen a genuine desire of investors to help, certainly in the initial round, but I think there'll be inevitable questions about, how do you compare these issues? How do you favour lending to one group of people over others? Some of these are quite conceptual. So there's still a lot of work to be done on the social side. And I definitely think that the G of ESG is going to continue. I don't see that going away. I think, again, that could be hooked up to some kind of economic stimulus packages that are not presently in force or in experience. But the themes that are coming up at the moment, there's a lot of discussion around social and making some of those social targets really tight, and how you define them, how you monitor them. They're not really straightforward or easy. So I think what we are seeing in the loan market at the moment, for example, to go back to somewhere that my previous role, we are seeing companies securing additional liquidity lines. There is huge concern that companies are going to have enough money to keep operating through this crisis, particularly in certain sectors that have been really hit hard by the crisis. So I think treasurers are very preoccupied at the moment with just finding money to keep going, to keep afloat, to keep paying out their employees. And I think that's taking front and center stage at the moment. They're all putting in additional liquidity facilities, which are short-term loans of up to about 2 years. And those do not have ESG language in them as yet. They're not designed to be around for very long. They're designed to tide companies over this period. So I think the focus certainly right now is on survival, although we're still seeing quite a lot of green issues, particularly around the sovereign and supranational space as the response to the virus kicks in. But I expect soon that will start to extend through the corporate sector, particularly in those sectors that are able to help. We did see, I think, our first corporate deals for a ventilator maker in Sweden, Getinge, and I do expect more of that. So I think in the immediate aftermath of the crisis, the focus is very much on survival and prudent finances and putting deals in place to allow companies to continue to trade. But the ESG discussion doesn't really go away. It's sort of existing in parallel. And I think that some of the way out of the recovery, and investors do want to help with this, is going to be targeted more and more at sectors that are in line with ESG thoughts and considerations. So yeah, I don't see it going away.
Super. I realise we've only got 8 minutes left, and I do want to get to another question or two, especially a couple of that are coming from the audience. We've got tons that are coming from the audience. We won't be able to get through them all. But, Andre, quick thoughts on the thematic focus within ESG. Where is it likely to be going forward?
Right, yeah. So I was actually going to reference some of Tessa's comments earlier about the intersectionality of these E, S, and G issues, because I think it's really important that we look at these holistically. And unfortunately, there tends to actually be a lot of jargon within ESG, which sometimes dilutes the issues. But if you think about it, on the environmental side, these are social issues, right? So if you think about air pollution and you look in the US and see which populations are closest to the polluting facilities, you'll see that's a social issue. If we look at climate change scenario analysis and see who are the most vulnerable groups, on a global basis, that it's clearly a social issue. So, I think some of the jargon around ESG generally and the sort of segmenting of these themes is actually doing a disservice to trying to solve some of these issues in sort of a value creation type of mindset. And then I also want to go back quickly to Chuck's comments on, companies essentially grading their own tests, if you will. That's part of our approach. As a technology provider of ESG information, we actually don't take in corporate disclosed information because we want to distill what the idiosyncratic risk is for companies. And we find that what they report on at times tends to be a distraction towards the core issues that actually affect their earnings algorithms, right? So that's something that we find and we're seeing that more and more in the marketplace in terms of, investor analysis and where they're focused. They're engaging with companies, but they're really focused on what the outcomes are of the policies as opposed to whether or not a company has a policy themselves.
Chaka.
I think if the question is which one of the three are going to be more prominent going forward, I think there has been a reset. So the E of ESG dominated discussion for so long. I think S and G have just been brought up to speed now, and there will be a degree of focus across all three now, equal focus, for the reasons that Andre just gave, which is that there's such a kind of interrelationship between the three. You can't really disaggregate them, I don't think, in a meaningful way when you're taking a big picture view of a company. What I would say, though, about the environmental side of the equation is that I do think that where there was skepticism before in some quarters about just how important it is from a financial point of view to the future viability and resilience of companies, I think people are going to take the data and what scientists and experts say a lot more seriously going forward than they did before the pandemic. Why do I say that? Because if you say look at the pandemic, there had been talk going way back about the inevitability that we were going to face a big global humanitarian crisis, if you call it that, of this order at some point. But it was all rather abstract. It was wonky scientists and experts telling us this, and people just easily dismissed it, not least the President of the United States. I think now, given that what was seen as abstract and just a kind of thing of conversation amongst boffins has actually become a reality, I think is going to cause a lot of people to reassess how seriously they've been taking the urgency of what the experts and scientists have been telling us around climate change. And not just from the point of view of how it's going to affect the planet, water levels will rise, some parts of the world will become uninhabitable, but just how it's going to have a very direct impact on people's standard of living. And we haven't seen really the full scale of the economic impact of what the pandemic poses right now because of the state support for jobs and businesses. Now, as that's gradually withdrawn, we're quite likely, some would say, to see levels of unemployment that we haven't seen since the 1930s Great Depression. Now, if you consider that has been the impact of the pandemic, multiply that several times, and that tells you what the impact will be if we don't actually keep the temperature rises below 1.5 degrees. So I just think people are generally going to take these a lot more seriously for all of those different reasons. So I think E is going to, outside of the investor community going to rise up the agenda, whereas maybe in the non-investor community, people were tended to focus much more on the social side of the equation?
Look, really, really interesting. I'm super conscious of time now. We're really at the last couple of minutes, and we're not going to do any decent questions justice. And I apologise to all the questions, all the people that raised questions that have come in. We've got a truckload, which demonstrates there's a lot of interest here, and we will look to respond to each of those offline. But I think we'll have to wrap up at this stage. I think that was a really interesting conversation. I think we had by the way, fantastic set of panelists. Thank you so much for joining us. Really great, cognitive diversity that we were able to bring to this conversation with this panel. And I think that, if there's one overriding sense, it's the fact that COVID-19 has brought home the fact that humanitarian and social crises have very meaningful business and economic impact. And there will be a stronger drive going forwards, I think, the panel would agree with me, in wanting to quantify and internalize those externalities. And so the likely focus on sustainability and ESG is likely to increase post COVID-19 crisis rather than decrease. But look, with that in mind, thank you very much for joining us. We will follow up with all of the pieces that we didn't get to cover in terms of the questions that you came to us with. And a final thank you to my panel. Thanks for joining us, guys. Thanks for all your insights.